Hello, traders! Have you ever entered a trade only to see the market instantly reverse and stop you out just before moving in your direction? That's not bad luck. That's a liquidity trap. Smart money knows exactly where retail traders place their stop losses, and they use that knowledge to manipulate the market. Understanding liquidity is one of the most powerful skills you can develop as a trader. When you know how institutions create these traps, you can avoid getting caught and even use them to enter high-probability trades with confidence. In this video, we'll explore liquidity, how it affects price movements, shapes market structure, and how you can use a strategy to spot and trade liquidity grabs effectively. Let's get started. Liquidity is the amount of money available in the market for buying and selling. When there are more buyers and sellers, trades happen more easily without big price changes. In a bullish market, market makers want to buy at low prices without making the price go up too much. If they buy when there isn't much liquidity or enough sellers, the price will jump. So, they wait for a dip where more liquidity is available, allowing them to buy without pushing the price higher. So, where can we find liquidity on the chart? In this example, retail traders place their buy orders at this support level, expecting the price to go up. But banks and market makers see this area as a liquidity zone, filled with pending orders and stop losses. To take advantage of this, they push the price down, triggering stop losses and filling their own buy orders at the best price. However, it's not just retail traders who get liquidated. Some banks and institutions also get stopped out if they were on the wrong side of the trade. Once enough liquidity is collected, the market reverses and moves higher. Let me show you some examples to identify where liquidity exists on the chart. Trend lines look like a great tool for many traders to identify the trend, but they can also be a trap. Many traders rely on trend lines for their entries. When price touches a trend line multiple times, they gain confidence, thinking, if price touches it again, I'll enter. They place their trade and set their stop loss just beyond the trend line, believing it's a safe level. But here's the problem. Since many traders do the same thing, market makers take advantage. Instead of respecting the trend line, price breaks through, triggering those stop losses. Traders panic, thinking the trend is broken. But in reality, this isn't a real break. It's a liquidity grab. Market makers use the stop loss orders to fill their own positions. Once they've collected enough liquidity, price reverses back in the original direction. But now, those traders are out, and they start thinking about why their trendline strategy isn't working, while the market maker has a different way of moving the market. The double bottom is a chart pattern that many traders trust. It appears to be a strong support level where the price should bounce higher after testing it twice. This makes it seem like a great buying opportunity. Traders often go long here, placing a stop loss just below the support level, feeling confident that the price won't drop further. But here's what really happens. Big players know this pattern is popular. They let the support hold for a while to attract buyers and build up stop-loss orders below it. Once enough traders have entered, the price suddenly dips below support, triggering stop losses. This causes panic selling to grab liquidity, where market makers intentionally push the price lower to collect orders. Market makers use this opportunity to buy at a lower price and fill their positions. Once they've collected enough liquidity, the price quickly reverses and moves up, leaving retail traders stopped out and confused. Why is my strategy not working? What happened? I followed it correctly. The issue isn't the pattern itself, it's how market makers exploit it. They take advantage of predictable stop-loss placements, stopping traders out before making the real move. Understanding liquidity traps can help avoid these setups and improve trade execution. Now that we've covered liquidity sweeps, let's get into how to actually trade around them and start explaining the liquidity grab strategy. On the JPY 5-minute chart, we can see a clear downtrend followed by a breaks of structure. The market shows a change of character, signaling a possible reversal. The price had been consistently making higher highs and higher lows, showing strong bullish momentum. After the change of character, two demand zones can be identified where price might reverse. As we discussed earlier, valid zones must have a liquidity sweep before price reacts. For this reason, the first identified decisional order block will not be considered a valid point of interest because the price did not sweep any liquidity before reaching it. Instead, attention should be given to the second demand zone, where a clear liquidity has been spotted. If the price returns to this validated demand zone, confirmation signals like bullish engulfing candles, lower timeframe break of structure, or rejection wicks will be needed to confirm entry. If the price does not hold and breaks lower, the bullish reversal scenario will be invalidated. Now, let's see whether the price will react. The price has swept the liquidity zone and shown 3 rejections at the demand zone, which could indicate that the demand is valid and market makers are involved. Additionally, a bullish candle has formed. Now we can enter the trade. We have enough confirmation to increase the trade win rate. Our stop loss will be placed below the rejection points, while the take profit level will depend on your risk management. In this case, I'll target a 1-to-3 risk-to-reward ratio. Mastering liquidity helps you find better trade setups and improve your strategy. Always include liquidity in any trade you take. Like, subscribe, and see you in the next one.